Right. Good morning, everybody, and welcome. Thanks for joining us here this morning. Nice to see a good, healthy crowd. There's still some number of seats in the front here. Anybody looking for a front row seat? They're going cheaply. So, very welcome here this morning, and it's a pleasure for me to present to you this morning the group annual results for Growthpoint Properties for the year ended 30 June 2025. Just scrolling down the agenda, I'd like to quickly give you an overview of the portfolio and what that comprises of today. Touch on some of the highlights, review some of the strategy that we've been working on, a few very short highlights on the financials, talk a bit to you about the international investments. Estienne will come and do an overview of the South African portfolio. He's very excited. For the first time in many years, he's got some pretty good news, which is wonderful. He'll touch on Growthpoint Investment Partners and the capital management side, and then I'll come back and just conclude in terms of our outlook for the next financial year. The business today essentially comprises the South African business, which is still the largest part of the business by quite a margin, 50% out of total assets, about 66 billion rands worth of assets across retail, office, industrial and logistics throughout South Africa. The V&A Waterfront, the other major South African business, 10% of total assets, about 13.3 billion rands worth of assets. Obviously, that one we own 50% in partnership with the PIC. On the offshore side, we have Growthpoint Australia, which makes up about 23.2% of total assets, obviously separately listed in Australia on the Australian Stock Exchange. Our market value of that investment is about 13 billion. We have Globalworth, 12.2% of total assets, just short of 30% stake in Globalworth, separately listed on the London Stock Exchange on the alternate investment market. Capital & Regional, New River, that's actually no more. I'll deal with that in some of the detail, but we have now exited that investment. We have Lango, which makes up about 1.7% of total assets. It's essentially a company that invests in property assets across Africa. And then we have our third-party fund management business, which used to include Lango, but since they internalized their management company, we now reflect it only as an investment. And we have about 8.6 billion rands worth of assets in the two funds, the Growthpoint Healthcare Property Holdings and the Student Accommodation Holdings business, making up about 1.8% of total assets. We've brought back highlights. For the last couple of years, it was just salient features, but we now have some highlights. And we're very happy to be announcing some of those. So our distributable income per share this year up 3%. We do see the year as a bit of a turnaround year. We started the year off, or this time last year, I guess, guiding for negative growth. And then at the half-year mark, we upgraded that to positive, and then we've actually exceeded the upper end of the range that we gave, but albeit marginally. But 3.1% up on distributable income per share. The dividend per share is up 6.1%, and that's mainly attributable to the fact that we've decided as a board and a group to increase the dividend payout ratio, and I'll elaborate on that a little bit later, from 82.5% to 85% for the year. The group LTV has come down quite nicely to just over 40% from 42.3%. Group property assets are down by 6% to 155 billion, principally due to the sale of domestic assets in South Africa, but the biggest moving part by far is the disposal of Capital & Regional. The net asset value per share down by 1.6%, and then group interest cover ratio improving from 2.4 to 2.5, and then the South African interest cover ratio is improving to 2.9 times. Now I'm having a challenge with this clicker. It was working very nicely early on. There we go. Right, so just touching on the the strategy, I guess, and there have been obviously a few investor concerns over the last couple of years, and we've tried to address them, systematically over the last 2-3 years. It's, as we all know, it has been a bit tough. But, on the equity side, we continue to look to simplify the equity story. One of the biggest changes there, I guess, was the disposal of Capital and Regional. We have internalized the Lango Manco, and sort of Lango's on a path, I guess, to IPO in the next year or two. And then we continue to look to diversify and the South African portfolio, and from a capital allocation perspective, looking at allocating more capital to growth nodes in South Africa. And we've got a targeted disposal program of about 3.5 billion, for this year. Again, moving out of less desirable assets in South Africa, allocating capital into better growth nodes, particularly in the Western Cape, and then also in terms of sector rotation into logistics. Strategically, on the SA portfolio, we did particularly well this year, I think, with the disposal of about 2.5 billion rands worth of assets in total. And we are feeling definitely a bit more optimistic as well in terms of the international assets, Globalworth and GARS, in terms of their financial position. Debt levels, we really have focused very heavily on fixing the balance sheet, and we've brought the LTVs right down, and the ICRs are improved, as you saw. But we're sitting with a significant cash balance as well now at the year end. So all things considered, from a funding perspective, we're pretty confident that, we've got lots of access to liquidity, and that, the disposal program has assisted in that regard. And then I think there was a lot of question marks, I guess, also about, future leadership. With my retirement at the end of next year, we did announce to the market, obviously, my successor, Estienne, who will take over on the 1st of July. And then we also announced the fact that with Gerald retiring, that retirement date is the end of March next year. But we have got Jose Snyders joining us. He's currently, or he's just resigned, I guess, as the CEO of Liberty 2 Degrees, but he will be joining us as Group CFO at the beginning of January next year. So just continuing along this theme of looking forward as to how we see Growthpoint in the next couple of years. I'm not going to focus on that looking back section, but really just a bit more on the looking forward. So what we see going forward is Growthpoint with a very high quality South African portfolio. We see GARS with pretty good growth prospects, with a solid balance sheet and good growth prospects into funds management business. We hope to see a restructured Globalworth and the shareholder impasse, if you want, between ourselves and the other shareholders there being resolved. We see a very strong growing V&A waterfront with significant development opportunities and growth opportunities. Growthpoint Investment Partners continues to have good growth prospects, especially with the broadening of the mandate of the healthcare fund to include aged care and doctors consulting rooms, which are attached, let's say, to these hospitals. And then on Lango, we ultimately see, following the internalization of the Manco and the redomiciliation of Lango, we ultimately hope to see Lango IPO in a year or two's time. So when looking at the South African portfolio and improving the South African portfolio, the emphasis continues to be very strongly focused on the balance sheet. So we have, I think, created for ourselves now, quite a bit of capacity, opportunity, I guess, to be more on the front foot and look at opportunities. The South African LTV, or the group LTV, at 40%, the GARS just under 40 at 39.5%, and then the South African LTV at below 35%. We have 4.7 billion rand worth of liquidity in the form of unutilized committed facilities. That number is down from the 6.2 in prior years, but that's quite a deliberate strategy. We feel that in the past, as we feel more confident, we don't believe that we have to continue to hold, such excess liquidity, but it's also driven by our debt expiry profile and what we have to refinance in the next 12 months. As I said, 0.9 billion of cash, and then the confidence that I guess we've got now has allowed us to take a view on the payout ratio. And we have decided as a board to increase the payout ratio to 87.5% from the 82.5%. That gives you for the year an average of 85%, and we're still thereby retaining 744 million rands worth of cash in the business for principally our maintenance capex requirements. So maybe I'll just take a minute or two and talk to this decision on the increase in the payout ratio. So I think as confidence has returned, and as we see, we no longer have to fund, let's say, the capital and regionals distribution, which we were receiving in shares. Even Global Worth, we see now in the final dividend they've just paid us now is coming cash. So all things considered, if we look at the growth coming through in the South African portfolio, we're feeling a lot more confident about the prospects going forward. There might be questions, are we ever going to go to 100% payout ratio again? And I think the short answer there is no. Principally, what we, as a broad principle, what we've adopted as a board is to say that to be sustainable, we need to retain sufficient cash to cover our maintenance capex at least. And that number runs at about 500-600 million a year. So the payout ratio at 87.5 will allow us to still retain 500-600 million a year in future. And, off the back of that, the board took a view to increase the payout ratio. On disposing of the South African assets and improving the South African portfolio, we sold 25 properties in the period for 2.5 billion. And we invested another 1.6 billion into various developments and capex. You can see from some of the items highlighted there, a focus on the Western Cape, Bayside Mall in Tableview in Cape Town. That property has been completely refurbed. We are just about finishing now the redevelopment and refurbishment of the former Investec head office building, 36 Hunstradum, 491, who will be moving in there before the end of the year. And then we completed the Hilton Canopy Hotel down in Cape Town. It's open and operating, and so quite a big emphasis, as you can see there, on investing into the Western Cape. Over the last 9 odd years, we have sold 186 properties worth about 15 billion, and we've now reduced the number of properties we own from 471 to 328, and reduced the total gross lettable area that we own by 18.9%. You can see from the two little charts or the two little graphics there that the portfolio composition has actually changed. We're from 46% office in 2015, FY 2015, to 40% office. Retail has remained stable at 39%, and logistics has increased from 15 to 20%. It is a big business. We started with 5.7 odd million square meters across the portfolio. To change the composition dramatically, does take a bit of time, but I think it's important, to see the outcome over time has been directionally where we want to head. Touching on more on the international side, optimizing the international portfolio. 38% of our property assets now are effectively offshore, producing 28, just short of 29% of our distributable income per share. The rand equivalent currency income from dividends, scrip dividends and cash alternatives, 1.4 billion in the year compared to 1.6 in the prior year. So we have seen some lower dividends, from Global Worth and GOZ actually, and then obviously the impact here of Capital and Regional coming through. We did dispose of Capital & Regional, and we ended up with 14.2% in New River as part consideration for the sale of Capital & Regional. Subsequent to year end, we have now also sold that and at a price of 75 pence, which was at a premium to the market, almost a 5-6% premium to the market at the time that we executed the trade. GOZ remains very core to us, and Globalworth, we continue to be in active discussions with the management and the board and shareholders on trying to unlock value from that investment. In terms of the two, in terms of Capital & Regional, we did earn about 140 odd million rands worth of income this year, partly consolidating Capital & Regional until the date of disposal on the 10th of December. And then we did receive a dividend from New River for 86 odd million. And Globalworth, we reinvested the dividend, the June 24 and December 24 dividend. Collectively, there was about 301 million rand worth of reinvestment. And then the most recent dividend that we've just received now is 122 million, and that we received in cash. Moving through the financial results and just trying to give you a sense of what the major contributors were, I guess, to the result. So the 3.1% growth in distributable income represents about 151 million rand. And the major contributors there being South Africa, 236 million positive. It is the first time in a couple of years, I think, that South Africa has screened positively. So that's very encouraging. We saw net South African finance costs contribute 23 million positively to that movement. And the V&A continues to perform well and contributed positive 35 million to the result. Then we unfortunately had a few negatives. So the GOZ dividend was a little bit lower, quite heavily impacted by the dividend withholding tax charge as well that we picked up in GOZ. The New River Capital & Regional sale resulted in a net 30 million negative move. And then the dividend from Globalworth was down 52 million, mainly due to a tax charge in Poland, that one-off tax charge in Poland, and then the impact of the higher interest cost, full 12-month higher interest cost on the debt refinance that they incurred in Europe on their Eurobonds. Small dividend from Lango, and then GIP and Training and Development both contributing negatively, albeit quite small numbers, 14 million and 10 million respectively. Very high level look quickly at the income statement. We see gross property income growing to 13.9, almost 14 billion, or sorry, not growing, but actually reducing by 4%. Again, the income statement and balance sheet quite heavily impacted by Capital & Regional and the disposal of Capital & Regional. So property expenses were down 6.4% to 4.2 billion, leaving us with net property income down 2.9%. At just short of 9.7 billion. Other operating expenses reduced by 6.4% to 1.055 billion, and leaving us with net property income after operating expenses down 2.5% at 8.6 billion. Ooh, I think that skipped one. Yeah, then we look at finance costs. Finance costs came down by 4.4% to 4.2 billion. And our finance and other income also just staying relatively flat at 1.329 billion. And that then after adjusting for the non-controlling interest, foreign exchange losses and other items, we left with distributable income of just short of 5 billion, 4.964, and up 3.1%. This slide just tries to reconcile the distributable income to the FFO number. So a number of company-specific adjustments that get put through, and that results in an SA REIT FFO number, which is pretty flat on last year, 4.436 billion and 131 cents per share. The distributable income per share is 146.3. And the dividend per share, based on the payout ratio of 85, the 124.3. On the balance sheet, just a couple of key features here. You can see total property assets down by about 14 billion rand or 10%. Again, very heavily impacted by the sale of Capital and Regional, but also negative revaluations still being experienced in GARS, in the office portfolio in Australia. The equity accounted investments, about 18.3 billion, the two big ones there, the Waterfront and Globalworth. And then looking down at the bottom, really focusing on the nominal borrowings, you'll see a significant reduction in total debt from 69, almost 70 billion down to 61 billion. That's almost a 9 billion rand reduction in debt. And that leaves us with shareholder interest at 1.7% down to 67.7 billion of NAV. Moving on to the international investments very briefly then, GARS. GARS owns 50 properties in Australia, just short of 1 million square meters, valued at about 48.5 billion rand. Their FFO did decline by 2.5% on the prior comparable period, and the dividend decreased by 5.2% if you exclude the 2.1 cent special dividend that GARS paid. Net for us, we received 1.011 billion distribution in rands effectively once we converted the Aussie dollars into rands, and that compares to 1.059 billion in the prior period, so a reduction of about 47 odd million there. GARS a very strong balance sheet. They have disposed quite actively or aggressively during the year. They sold a stake in DXI. They also sold 7 assets to the Growthpoint Australia Logistics Partnership, realizing about 335 million in cash. That was used to effectively settle debt, bringing actually the LTV down to the 37 odd level, but that was prior to the revaluation of the assets, which was negative, taking the gearing back up to just under 40 odd %. Liquidity in Australia for GARS is good. They renegotiated 645 million of bank debt. They converted 320 million into a sustainability loan with average tenor of 5 years. Lots of undrawn facilities, and so with the revaluation of assets downwards, we did see GARS NTA decrease 10% though to $3.09. 85% of their debt is fixed, the weighted average debt maturity of just short of 4 years, and the weighted average cost of debt of 5%. On the portfolio level, it's about $4.1 billion of assets on balance sheet. Over 80% of income comes from government and from listed corporates. Higher level of occupancy, 94% by rental value. Weighted average cap rate 6.7%, weighted average lease expiry 5.6 years, and as I said earlier, good leasing, and then 6 properties sold. Like for like property FFO is up 3.2%. So operationally, I mean, GARS is doing well. We are seeing the end of the, let's say, negative cycle as it relates to office assets in particular. The one city that is still struggling a bit is Melbourne. And if you look at the downward asset, the write-downs in asset values in GARS this period, it was almost exclusively attributable to assets in Melbourne. So Melbourne office market is struggling a bit, but certainly Sydney, Brisbane, Adelaide, Canberra, wherever else we have assets in Australia, office assets, they're doing well. Industrial portfolio continues to perform well in Australia. On the fund management side, we have 1.4 billion of assets in effectively, I think, in a number of funds. I forget the exact number of funds that we have there. During the period, $328 million of new assets under management was created by the team. The biggest one of that is the Australian Logistics Partnership, which is we created a logistics fund with the TPG Angelo Gordon investing 80% of the capital into that fund and GOZ co-investing 20%. But these were effectively assets that GOZ had on balance sheet. And then we also had the separate establishment of a new Canberra Office Trust. It's a $90 million syndication, effectively taking a significant office asset in the Canberra market and syndicating that with private investors. So 170 million in gross equity was raised. The increase in funds management fees revenues were 20%, and then over 45% of new investors in the funds management platform for the period. Capital and Regional, I'll skip this through this very quickly. It is now effectively post year-end off our balance sheet. At balance sheet date, we still reflecting the New River stake. But yeah, following, I think, an internal review and a strategic decision was taken that the asset was not core and that we really weren't in a position to allocate more capital towards the entity, to grow it, to make it relevant. And off the back of that, we ended up deciding to sell the asset. Total, we realized about 2.5 billion of cash in two tranches, the 1.2 billion at the outset and then the 1.3 billion from the sale of the New River stake. And then Global Worth. Global Worth owns 56 properties across Romania and Poland, just over 1 million square meters. And our share of that, 29.6%, valued at about 16 billion rand. The 33% decrease in the dividend from Global Worth. Those were the two major factors there, as I mentioned earlier, was this big tax charge that we picked up. It is a one-off, and we don't see that repeating itself. And it talks to intercompany funding and withholding tax on interest, that some of the Polish change in tax law. And then the higher refinance costs. Now, the higher refinance costs are now in the base, so that Global Worth had about, it was over 800 million euros worth of bonds that had refinanced in May 2024. So for our 12-month period to June 2025, Global Worth does have a December year-end, so the periods don't coincide perfectly, but in essence, for Global Worth, they've now had the higher interest rates for a full 12 months. We have shown the impact of that. It's in our numbers, and that certainly would see a stabilization of that interest charge in the going forward. So at the net income, operating income level, again, operationally things are performing pretty well, especially in Bucharest and in Romania. Warsaw in Poland continues to perform very well, but unfortunately we do have a few challenges in some assets in regional Poland where vacancies have crept up in some instances to 30%. But from a financial perspective, we're seeing, Global Worth having stabilized, liquidity is good, 325 million euros of cash on the balance sheet with 115 million of undrawn facilities. There were some revaluations, 50-odd million revaluation on the assets for the period, and they were successful in refinancing 100 million euro debt facility. Gearing has come down very nicely, sitting at 38%. On what I would say realistic and conservative asset values, and there's no real debt refinancing issues in the short term. 62 million euro facility in February 27 being the earliest. On the property side of things, in Romania there was a disposal, 50% share of an industrial asset was sold in July 24. And then there was a small industrial asset delivered, 5,900 square meter development of a property in Romania. On the Polish side, we're still busy with a redevelopment of the Renoma asset. That's a 48,000 square meter mixed-use facility in one of the cities in Poland. and there is still some land available, in that Polish portfolio for future development. The portfolio metrics, I think, are pretty healthy, and I'd say, as I said, from our perspective, we think that that particular business has stabilized, and we're looking forward to possibly, if nothing, at least stable dividend growth next year coming out of Globalworth. All right, and then lastly, Lango from my side, just we own 15.7% of it. It did acquire $200 million worth of assets during the period from Hyprop and Attack. That was settled partly with cash and partly with issue of shares. Lango did the internalization of its management company during the period at a cost of $60 million. The Manco shareholders received those $60 million in proceeds in the form of convertible instrument, which converts into Lango shares. And our share of that was a gain of 331 million. It has re-domiciled December 24, and it is now a UK domiciled company. And from our perspective, we have excluded it from our Growthpoint Investment Partners numbers from 31 December 24, and is now shown as an investment. As I said, Lango is on a path to an IPO. It needs to raise a bit of equity, but many of these actions, including the internalization and redomiciliation, was all preparatory work for and positioning it for this future IPO. Right, and then I'm going to hand over to Estienne.
Cheers. Morning, everybody. Thank you, Norbert. All right, so we're going to talk about a little bit of action closer to home. And as Norbert pointed out, things have gone quite a bit better this year. In fact, significantly better than what we originally envisaged when we gave guidance to the market at the beginning of the year. And you'll see there's quite a lot of moving parts, and I think the team have had their head in the scrum, and we're starting to see some of the benefit of that hard work coming through in the numbers. So when having a look at the newly named highlights, we renewed close to, just over 1 million square meters again this year. So you can see from that a huge machine in terms of renewing multiple leases every year, and clearly looking for new clients in a market which remains very, very competitive in all three sectors. In the period, we grew like-for-like income, so that's given all the sales, we stripped those out, and all the new developments. So the like-for-like growth is 5.9%, which is the highest it's been in some time. We had vacancies of 8.2% at the end of the year, and the positive thing there is the trend is moving lower. And when we look at the separate sectors, I'll comment on those vacancies along the way. Renewal growth still remains a little negative, but a marked improvement from the negative 6% in the prior year. Renewal success rate at 68%, probably a little bit lower than we'd like it to be, but it's indicative of the market that we're operating in, which remains very competitive, and many tenants, when renewals come up, use the opportunity to downsize or look at alternative accommodation for their requirements, which seem to be changing all the time. The expense ratio improved to 36.1. Our arrears, the book is pretty much back to pre-COVID levels. So just to give you a flashback, I think that arrears number went up to 650 million rand in the eye of the storm. And it was really pretty sticky for a couple of years. And the 68 odd million is more or less, what it was prior to COVID. So I think we pretty much back to those levels. Provisions, as a result, are slightly less. Our finance cost came down marginally, a combination of sales and a little bit of lower interest rates. As Norbert mentioned earlier, our balance sheet is very conservatively funded. If you think about sort of the mothership, so we don't have recourse debt from offshore. So for the bankers in the house, at 34.5%, it's a pretty conservative gearing ratio. And as Norbert pointed out, our interest cover ratio on the South African balance sheets now at 2.9 times. So it has improved significantly. For the first time, we've seen quite a reasonable increase in valuations across all three sectors. That equates to about 1.4 billion rand, 2.2%. And I think hopefully if the sort of momentum continues, I think our very conservative valuing fraternity will have a little bit more confidence in the underlying values as well. And one would think that if you're maintaining or growing your income at roughly about 5.5 odd %, you should see valuations increase more or less at that level. And at the same time, if you see yields or interest rates coming down, that could be pretty positive for valuations going forward. The development pipeline and the sales sort of talk to each other. It reflects that, we have not lost hope. We continue to invest in our portfolio, and we are recycling capital quite significantly in this business, in improving the quality of the portfolio and continuously investing in this business. Looking at logistics and industrial, so of the three sectors, this has been sort of the best performing over the past few years. You can see from the vacancy levels that the market is a little bit more favorable to the landlord in this environment. I think Norbert mentioned how we have sort of changed the makeup of the portfolio mix between retail, office and industrial, but also within the portfolio we've brought down the types of the number of assets that we have and the types of assets. So much more logistics in the portfolio today, larger assets, better quality tenants, newer properties, and a lot of the development activity has really been in this space. If you look at those vacancies there, many of it comes from that development activity. And what we have been able to do is, been able to re-let quite actively in this portfolio. So renewals are at a very high level, and we continue to have a high escalation rate in the portfolio. So that delivers sort of a like-for-like growth at 5.5%, and valuations increasing at 3.1%. We have sold 14 properties, close to R1 billion worth of assets, and we continue to look at selling out of specific nodes strategically and using that capital and developing quality new logistics facilities in areas where we control the node a little bit better and control the environment, so typically in parks or in controlled nodes where we're looking to invest. On the retail side, the vacancy levels at 5.3 is, I would say, sort of a little bit overstated in that if you in that portfolio there is a bit of office, and it is a little bit lumpy. So it works out to just, let's say, around about 56,000 square meters, but 11,000 of that is in one shopping center that we're busy working on a solution for at the moment. We're busy letting in Alberton City. We've done quite a bit of work on Brooklyn Mall as well. So shortly we'll probably have to make a big decision whether we proceed on redeveloping or refurbishing that mall and repositioning it to fill some of these vacancies and reposition the mall. I think the other positive thing in the numbers here is also on the renewal side. We're now getting much more positive renewals than negative, and if you look at the rate that the tenants are paying per square meter, certainly I'm reasonably confident that there is still upside there. So like-for-like growth at 5.3%. A lot of work has been done on the recovery side. In this portfolio is also the portfolio that's been mostly impacted by solar rollout. So just in the period, we rolled out 10 new shopping centres. We rolled out solar. So you're going to start seeing the benefit of that coming into this coming year in terms of savings in electricity, and that will have a positive impact going forward. Valuations also increased by 2.2%, and we managed to dispose of 5 properties close to R1 billion. One of the big properties there was the Golden Acre, which transferred right at year end. Some statistics on the retail side. So our average trading densities have increased by 4.8%, which is better than the rest of the market. If we use the CLUR index, which is an index that most of the retail players are now submitting information to. You can see in the different sort of segments where the most growth has been. So if we look at community centres and specifically the Western Cape, that has definitely shown better results. Our rent to turnover ratio, which I alluded to earlier, at 7.7, I would say, I don't know, Gavin, I think we're confident that that is a reasonable level, and that from there we should actually have a little bit of scope to squeeze retailers for a little bit more rental potentially in the future. And that will have a positive impact on that negative renewal growth rate. We are seeing growth in foot traffic, which is positive, because actually post-COVID, the trend had been that actually you didn't see much growth across the board in foot traffic in many of these shopping centres, but we are starting to see that come through now, which is very positive. On the office side, so this portfolio was the dark horse that probably has come through stronger than what we have expected in terms of performance. Vacancies have come down quite nicely to 14.6. There's still a bit of work there, a little bit of upside, because if everything's full, there's no upside, right? So analysts like a bit of upside. So there's still a bit of upside. And the reality is that in Gauteng is where the challenge lies in the vacancy side. So a lot of work being done there. If we look at the markets in KwaZulu-Natal, we've got an 89,000 square meter portfolio. It's full. In Cape Town, our vacancies are normalized and actually reasonably low, and we're starting to see rental growth in those markets and coming off quite a low base. So, it'll speak to the like-for-like growth, which I'll touch on now, but those are some of the drivers of that like-for-like growth. The renewal side, it's still, as you can see, very, very competitive out there, very difficult to retain your tenants. And we're effectively keeping 2 out of every 3 tenants still in this period. So it is a difficult market, and I think going forward it'll still be a pretty bumpy ride into next year. So we have cautioned in the announcement that we know of a couple of rather lumpy leases coming into this year that will have a negative impact on the renewal rate, which improved materially in this year from 14.8% last year to 3.2% negative is quite a material move, but there are big leases that will impact this first quarter. But generally, you can see that it's starting to move to an area where we're starting to see a couple of positive leases coming through. In fact, you pretty much half of your leases now are either flat or positive, which is really a big improvement from prior periods. As you can see, the like-for-like growth there at 6.8 outperforms the other 2 sectors. A lot of work here has been done on recoveries and focusing on the expenses. The nature of office, I think, is also changing, where increasingly we're going to have to become more of a service provider, so instead of a box provider, where tenants move into. And a lot of quite innovative initiatives have been launched over the period, which certainly I think will help this portfolio going forward. We have managed to sell some assets. We're very careful when we dispose assets into the office market. We do not want to create competitors which can undercut us on assets we have disposed to them. So a lot of the disposals have been pretty selective to either developers that are converting their use or owner-tenant sort of scenarios. So, but we are actively looking at getting rid of the bottom end of that portfolio and continue to invest. So we opened the Hilton in Cape Town on the back of good demand for hotel space in the Cape market. We're busy with 91's building. They should be moving in December. And then we're busy in Sandton, for those that have suffered some of that traffic inconvenience. I do apologize, but there's going to be a lovely walking bridge across there, which we've been working on since 2007. So it is reasonably momentous for us. It's not easy when you have to deal with the local councils in Johannesburg. So anyway, right, on the development side, I think when looking at those numbers, you have to appreciate that as we ramp up activity within the portfolio, it's better for us to use our skill sets and capacity on that. And you'll see a slight reduction in the fees being generated out of the trading and development team. In saying that, in this period, we did launch a residential scheme for disposal called the Olympus. It's just behind Discovery, and we've been very surprised, to be honest, on how successful we have been in selling units there. So we're going to ground now on this side of the year with the earthworks, and we'll be commencing construction on that development early next year. And that the idea is to sell those units for profit, so that in 2 years' time, we should start bringing some of those profits to book. The other activities that this team has been busy with is developing for our funds. So they've been every year developing 1 or 2 new student accommodation facilities. They're currently busy with a very large one at the gates of anybody been who comes from Natal University? Anybody? Nobody. Okay, so at the gates in Glenwood, we're building a very large facility of 2,500 beds there called at Howard College. And then we do have a few units that we are busy selling for profit, and that those profits will come through the books in the future. Then on the ESG side, I think this is increasingly important in our business, and Growthpoint has focused on this area for over 15 years now, and I think some of those benefits are certainly to be seen in the statistics. We have ramped up our investment into solar. Today we've got 80 plants with 61 megawatt peak production. We also entered into a PPA agreement where we're going to be acquiring 195 gigawatt hours of power. Ultimately, the idea is to get to close to 40% of our total electricity supply coming from green power. On the back of that, what we have done is we are passing that through to some of our tenants as an incentive for them to stay with us or to come and move into one of our portfolios, and we've created a very innovative product called the Eco2 product. So what the benefit is for any of you that would go into a building that is being provided with the Eco2 product is that firstly you'll be getting green power, and on top of that you will have access to the renewable energy certificates from your utilization, which you then can get on a blockchain system called Fuel Switch, and you will have then the opportunity to either dispose of those at a very nice profit or use them to reduce your carbon footprint. So for very large tenants, this is a very, very attractive initiative, and it's the easiest way to reduce your carbon footprint. And I think over time it will make our tenants stay in our buildings quite a bit longer. And then we're also focusing actively on water and waste, and we have added those into the management of our ESG and sustainability programs. Then on the people and community side, we retained our BEE status. Growthpoint remains a black company at level 1. We have once again spent a significant amount of money on CSR, and we've seen a lot of beneficiaries in the year benefit from this. Most of you will be familiar with Growthpoint, which is our enterprise development program. In fact, it's probably become a program for the whole property industry now, and many of our partners in the industry are using Growthpoint. So important focus for our company, and it's also really works pretty well within the business in terms of when we develop or run our shopping centres, etc. Some of these providers are actually becoming providers to Growthpoint. Then on the waterfront, now here the statistics are eye-watering. I think in a global context, we haven't seen statistics like this on any asset. It's a really feel-good story for South Africa, and shows you what can be done if you're operating in the right policy with the right strategic plan. So, from a highlights point of view, I don't think there's one lowlight in the whole presentation on all these slides. I mean, net property income grew 10.4%, even though we're busy refurbishing the Lux Mall, and we took the Table Bay offline to refurbish it. So, material increase in income there. At this stage, we've also been pivoting in the hotel sector. We've been trying to convert, as and when those opportunities arise, the hotel leases to operating agreements. And today, the operating income has increased to 16% of the total income for the group there. Like for like, net property income increased by 12.7%. I mean, that is a phenomenal statistic, and 24% growth in turnover in rental due to increased tourism in the hotels themselves. Vacancies are non-existent. Visitors are over 24 million. The one driver has been the increase in tourism to the Western Cape, and maybe not too many people know, but actually South Africa's tourism numbers are actually still lower than pre-COVID levels. So the V&A and Cape Town is really bucking that trend. Overall, I think we are 15% roughly above pre-COVID levels at the V&A and in Cape Town. So really putting Cape Town on the map from a tourist perspective globally today. We also commissioned our desalination plant. Now that plant will be providing close to 80% of the water requirement in the V&A, and that really does help in terms of potentially making a good case for increasing the bulk rights that we have applied for in the city. And then we've successfully developed 5 Dock Road. I think there's 98 units there, luxury units, of which they've already sold 92. And so please get in there, Evan. You need to go and buy yourself. There's only 6 left, but they're flying off the shelf. So it's a really nice spot. It looks out on the mountain. It's going to be spectacular. So get in there before they're all gone. Then on the funding side, the waterfront is now being funded on balance sheet, which gives us quite a nice pipeline of capacity there for the partners, being the GEPF and Growthpoint. Ultimately, we're going to be getting to roughly about 5.4 billion rand of debt, given the refinances and the new finance applications that we have put in. Currently, there's roughly about 3.3 billion of debt. I'm not going to go into the gory detail of what's hedged and unhedged for this purpose. Then running through the sort of sectors, retail sales have increased by 5.8%. even given the fact that we're busy working on the Lux Mall, which took 3,700 offline. The turnover in that shopping centre is now over 10 billion. I mean, in December last year, turnover creeped over R1 billion. The trading densities at 9,048 Rand is probably double that of any other shopping centre of the same sort of size. And the reality is that the renewals on the back of that is growing at 6%. So, it really reflects a very positive environment from a retail perspective in that market. And there's many things that are sort of having a positive impact on that, and the tourism side and what's happening in the marine side is also helping that story. So the other little thing that was also added was we finally managed to open the Union Castle buildings. For those that don't know, that is a new or refurbished building there's a Nike store, a Thule store, and one of the most beautiful stores I've ever seen, a Wedgwoods on the ground floor. We've got an office in the middle, and on the top there's a brand new marble restaurant, which has the most incredible vistas of Cape Town. So I do encourage you, when you do pop down there, to go and visit that as well. On the office side, these statistics office people can only dream of, which is net property increase, income increasing at 17%, like for like at 10%, vacancies non-existent, and renewal growth rates in a positive territory, and basically retaining pretty much most of the tenants that come up for renewal. On the marine and industrial side, we've also seen a vast increase in the vessels that are coming around the Cape as a result of the conflict in the Middle East. And the reality is with that comes, quite a lot of tourists. We have had over 170,000 people hop off the canoes and drumming into the hotels and into the shopping centres, helping drive those statistics. And then on the casual berthing and tourist yachts and commissioning new vessels and charter boats, that has all remained very, very strong. And we've seen on a 12-month rolling basis that increased by 15%. Then one of the biggest drivers of the income in the V&A has been the performance of the hotel and leisure side. We've seen a 10% increase in income, even with the Table Bay coming out. Okay, so like for like at 27%. And that hasn't come with additional bums and beds. It's actually mainly rack rate. As you can see, the V&A's rates have gone up by 23%. And we've also, in this period, as I mentioned earlier, we've now got 3 hotels that are on operating contracts. The Table Bay will come back on stream in December this year in a phased basis. So I think there's about 200 of the 300 beds coming back in December, and then we're also busy building the luxury hotel on Quay 7, which will open middle of the year, which will be very exciting. Then on the residential side, vacancies are very, very low, and success on renewal is very, very high. So it speaks to a strong letting demand in the area, and the newly refurbished Helistop is trading also up 30%. So really a good story. Then on GIP, I'll just touch briefly on this. So we've got 10 properties in the healthcare fund today. We still effectively own 39% of this fund. We receive asset management fees and dividends from that fund. On the student accommodation side, we now have 15 properties. It's over 10,280 beds. So probably, if not the largest, one of the largest student accommodation providers in the country today, trading under the Thrive Student Living brand, and making a really positive impact on our campuses at the larger universities today. There's also quite a nice pipeline of opportunity that continuously will feed this fund in terms of opportunities going forward, which drives the bottom line and growth and distribution that you can see. So our distribution increased from 17 to 29 million from this fund. Then on the capital management side, we have reduced the content here, so bankers do not fear. There are 8 slides in the annexures, which you can crawl through, which gives you all the detail on which hedge was re-hedged and at what rate and all those wonderful things. So we just thought for this presentation we'll kind of keep it high level. So we have managed to reduce our debt. Our LTV has come down to 34.5 on the South African balance sheet. The cost of debt has reduced from 9.6 to 8.9. And if you then blend in the CCIRSs and foreign denominated debt, it brings it down to 6.9 from 7.2. Our weighted average length of debt, so the term on those loans, is 3.8 years. And then for the bondholders, there's still a nice pool of unsecured assets. There's only 41.6% of our debt is secured. Good liquidity with 4.7 billion rands worth of available facilities and close to 900 million of cash on balance sheet. And we've proactively been hedging interest rates. As you can see, the 1.6 years is probably a little bit shorter than what you have been used to in prior years, but there is a strong feeling around the board that the interest rates will continue to come down, and we want to be positioned better for that. And then Norbert, if you can come back for the conclusion. Thanks.
Thanks, Estienne. And just keeping an eye on the clock here, it's just gone on an hour, so I'll try and wrap it up quite quickly. I'm not going to read what's on the slide there, but I mean, just in summary, I guess, with the, let's call it the more positive outlook for the South African business across all three sectors, as Estienne has highlighted. With the positive outlook for the waterfront, waterfront's looking at double-digit growth in its distribution to ourselves next year. It is principally driven by the profits on the residential development 5 Dock Road. Though, as Estienne said, most of those are sold out. We expect transfers to take place probably in the first couple of months of next year. So it'll be in our second half of our financial year, which ends in June 26. And we would be looking at distributing those residential profits. We will also have the Table Bay back online by then. And as Estienne mentioned, the new Key 7 Hotel only probably going to be opening up towards the middle of the year, so unlikely to impact the waterfront's results for our reporting period next year. So that's on the SA front. Also, if you consider, I think, the outlook for interest rates, we're still, optimistic that there's going to be a few more interest rate cuts. And then if you move offshore, consider, GAS has put out its distribution guidance. It's slightly up, I think 18.4 cents compared to the 18.2 this year, excluding the special divvy. And Global Worth being stable. As well as GIP and the contributions from GIP, both in terms of asset management fees and dividends from the underlying funds being relatively stable. With that sort of level of positivity and optimism, the board have taken a view, and we're confident to project and forecast that distribution growth per share next year will be somewhere between 3 and 5%. And if you overlay on top of that the higher payout ratio, which will apply for both distributions next year, the first half and second half distribution, you could look at this dividend per share growth of between 6 and 8%. So I think that concludes. Just to add, there are in the order of 67 odd annexures in the document, in the IAS presentation, providing all the detail that you might want, and provides a lot of better insight into some of the highlights that we have presented here today. I am aware that there are a number of questions online, and we'll take from. Do you want to start with the floor? All right. Yeah. So if you get preference,
that's
if you come in,
if you make the effort, you get the
online. You have to wait.
Thanks. I agree with that. We did drive all the way here. So just so two main questions, right? From me, I'm looking at the leadership, right? So we think we all have our own ideas about what might happen, but with Estienne being promoted to Group CEO, I want to hear from you guys, will there be a new SA-based CEO that's going to be hired in the next year?
So I think the short answer to that is we are busy going through a process with the board on looking at the operating structure going forward under Estienne's leadership, together with bringing Jose on board. At this time, the view is that we're not going to replace the CEO, the SA CEO role. That role would become won't be part of the group structure going forward. And that whatever the roles and responsibilities are, that have been fulfilled by myself and Estienne over the years, will be shared, if you want, between Estienne, the new CEO, and whatever the new group structure is that we end up concluding. So there's a lot of work being done with the board on that at the moment, and as soon as we're able to share, more details on that, I guess we'll do so with the investors. Yeah.
Okay, cool. And then just with regards to the finance costs, I think things have changed since the pre-close. So I'm interested to know, what are the current margins that you're getting on new facilities right now?
So Asha, our treasurer, is in the audience here. I'll give it a stab. And Asha, if I make a hash of it, please feel free to correct me. But I think it's fair to say that we're still seeing significant access to liquidity. We are being inundated with inbound inquiries, not only from investors into bonds, and term ranging anywhere from 3 to 10 years. The best rate we got recently for 10-year money was 135, 134
for 10 years. 183.
10 years was 183.
Yeah, 183.
133.
183.
83. Yeah, 183. 10 years. 10 years.
10 years.
10
It
years.
was, no, but it was 3 years.
Yeah, 183.
Post year end, it is in the post balance sheet events, but post year end we did a private placement. 3-year money we did at Java plus 100, and 5 years at Java plus 120.
Okay.
So that's in the bond market.
And then the difference between your bond market pricing and what you're getting from the banks?
A little bit we don't like, because we like them to be competitive, so we don't disclose that. But it's a few basis points above that, so it's still very, very competitive. I think you would see between 10 to 15 bips above bond pricing.
Okay, and then just lastly, with the subs being renewed, I assume that a lot of them are going to be in the money. Is that within the guidance as well? Is that assumed that there'll be some finance cost benefits?
There will be a little bit, but some of our finance, the swaps maturing, you'll see it in the slides at the back in the annexures, they're still at quite low rates in comparison to, I think this is the last year for the AUDs, where the cheap AUDs roll off. ZAR, we're just about there now, I think, with the cheaper swaps rolling off and where we can refinance. I think with ZAR, we'll start seeing some benefit going forward.
Okay, thanks.
Thank you. Any other questions?
Any other questions?
Okay, if not, we'll take one from the iPad here. Hi team, mention was made of progress with regards to GWI future strategy with other shareholders. Can you provide more color on this, or provide various options being considered?
I'll take that one. Unfortunately not. I mean, Globalworth is a separately listed entity on the London Stock Exchange, and it would be inappropriate for me to be providing any details here as to what strategies the board and might be, and management there might be considering to unlock value. I think what I can say, and I have been saying for the last couple of years, is that it's probably not an optimal situation for 3 large listed companies all to have a 30% share, roughly equally, in another listed company. So ultimately, I guess what we're looking for is a solution where each shareholder can be in control, I guess, of their own destiny with regards to their investment in Globalworth. But I can't provide any other specifics or details, unfortunately.
Okay. Then improved LTV and being on the front foot to take advantage of opportunities. Are these still primarily focused on offshore, or will you look local too? If the former, which geographies tick the boxes for GRT?
So I'll start with that, just to sort of highlight again the fact, I think over the years, whilst we may have spoken a lot about offshore opportunities and in fact, have allocated capital offshore, we've never ignored South Africa and had a complete investment strike, if you want, on South Africa. Every year, the number ranges between 1.5 and 2.5 billion has been invested domestically. 600 odd million is basically what we call maintenance capex, and then over and above that, we've been investing quite heavily in logistics. Through our T&D team, we've been buying land and developing logistics assets, both in Cape Town, KZN, and Gauteng. We bought some land recently, the Nocker Park development that's out
Towards the airport.
Towards the airport, where we've got a joint venture with Veenstra, looking at some further industrial development. We're looking for land opportunities in the Western Cape. We've got a few, but we'd be happy to take on more for industrial. So there is probably a bit of a bias towards Western Cape. If you saw, this particular results presentation of the 1.6 billion that we spent on capex and development, a big chunk of that was spent, in the Western Cape. Not only on existing assets and refurbishing and repositioning existing assets, some of it a bit defensive, but definitely looking at more actively at opportunities in South Africa than we probably have been over the last couple of years. So it'll be definitely a mix, and clearly waterfront. The extent of the investment in the waterfront is very significant. There's probably at least 4.5 billion rands worth of projects on the go as we speak. We are in a process with the City of Cape Town to apply for additional rights. If those come through, there's a 10-year future development pipeline, within the waterfront.
Right, and the next question is in respect of Brooklyn. The request is how much capex will be spent. What are we considering? How low will the yield be? Is it defensive capex, extra? So maybe I can't answer those questions, and neither can Gavin, because at this stage, we've obviously got a concept. So just context. The Brooklyn is a very, very well-established regional mall. We've got a partner there in Attack. They own 25% of the mall, so we work closely together with them. This mall is in Brooklyn, which is one of the more affluent suburbs of Pretoria, on the east of Pretoria. And as malls go, they do get a bit older, and it has been opportune for some period for a refurbishment on that mall. So it is something that we've been working on. We have had game that were moving out, then they weren't moving out, then they were moving out. So we have been getting very high income from them, and they have now finally moved out, which sort of triggers the opportunity to look at this redevelopment of the mall. But as we get more details, we'll definitely provide it to the market.
We've seen wonderful architects' drawings and perspectives of a phenomenal redevelopment, which will make it a very new, bright, light, and exciting mall. But unfortunately, we haven't seen the numbers yet. We still got the costings are still being done.
Exactly. That's the proof in the pudding, unfortunately. So, right, then there's another question. What can be done to increase the value of global worth? Operational figures seem to develop positively. However, the stock price seems to be substantially undervalued, and the company versus its acquisition cost. Would it be an option to list the company on the Bucharest Stock Exchange to address a growing base of investors versus AIM listing?
I would just maybe say no. I don't think it's certainly not been contemplated to list it separately. The reason the share price lags is 95% of the shares are held by 4 shareholders. They've got a free float of 5%. Nobody buys it. There's zero liquidity in the stock, and you wouldn't be expecting anything else, to my mind, with a 5% free float. None of the major shareholders have traded a share in the last 5 years. So, I think, that's the reason for the underperformance, or where the share price is sitting relative to its NAV. significant discount to NAV. I think it's a 50% discount to NAV. But I think listing it on another stock exchange is, is not an option being considered.
Is it an option to buy out the partners?
Could be.
That was the next question. Right, then what strategies are in place to improve the offices in Gauteng? So I think there's multiple strategies. Certainly, I alluded to, for instance, the Eco 2 product. We've also just recently launched quite an innovative incentive for clients where they can, which is called Swift Flight, and it's a JV with SAF Air, where we've got an online blockchain platform where part of the incentive for tenants can be provided to them in coupons for flights, which they can redeem with SAF Air. So there's going to be more and more of these kind of incentives. We've got, all sorts of clever ideas that we're busy working on, and you can start seeing the benefits of that. I mean, we've brought down those vacancies materially in office. It doesn't fix the fact that the Gauteng economy is very, very difficult. And on the back of that, you're not seeing really expansionary demand in office. But what we have seen is the occupation levels in offices have increased as more and more people move back to the office. So it's only the asset managers and analysts still at home, really. And the reality is that the other people are working, and and yeah, we are seeing really improved demand as a result of that. But you can't buck the trend in terms of the economy, but we are building all sorts of interesting incentives and products and services that over time will have a very positive impact on the office market. And that's the last question. Anybody else got anything? Thank you very much.
Thanks, everyone.